With regional banks in trouble in the US, with the New York Community Bank Corps declaring that they are going to cut their dividends because they have a financial situation, financial problems, which have been going on effectively since March 2023, this will send the US regional banks into further crisis. The index, or the ETF on regional banks, dropped significantly when that news came out of Bank Corps having to cut the dividends and cut expenses in order to survive. And this is going to be endemic of the rest of the banks within the US regional banking sector. If you remember what happened over a year ago, less than a year ago, in March 2023, when you had some regional banks go bust. There were Silvergate, Silicon Valley, Signature Bank, First Republic, all effectively went bust. And the FDIC, the Federal Deposit Insurance Corporation, and the US Treasury with the Fed had to come and bail them out. Some of them were merged with other banks, others were giving a temporary loan. That temporary loan is called the BTFP, the Bank Term Funding Program, which was approved by Congress at 60 billion US dollars. That fund, or that loan pot, is actually grown to over 135 billion and has to be repaid by the regional banks in March 2024, of which they've got no money. So they've got no money to pay it back. So what's going to happen? Well, there could be turning into a major banking crisis. A little bit of cracks or rocking of the boat could cause the stock market to drop 25%, and that could come from the regional banking crisis. Now, this regional banking crisis has been sort of bubbling along since about January 2022, when yields, that is the coupon or the interest rate on bonds, shot up and the value of those bonds dropped. By the value of the bonds dropping, the regional banks that were invested in all of those bonds, because bonds are as good as cash, those value of the bonds dropped, and therefore the net asset value of the holdings dropped, and that caused a liquidity problem with the banks in raising money in the money markets. So along came the Fed in March 2023 and bailed out a lot of those regional banks. However, it's not gone away, and the crisis is actually deepening. Even though it's not been reflected yet in financial markets, it is there. And the first crack, it's been happening for a while, but the first crack that was recognized openly, even though I've been talking about this for months, was on Wednesday when the Bank Corps came out. New York Community Bank Corps came out and said they've got difficulties. There's an immediate spotlight put on all the other regional banks. You can't avoid it and you can't ignore it, even though stock markets at the moment are totally focused on other things like Nvidia and like Meta and like semiconductor chips and AI. They're not focusing at all on where the crisis is brewing within the regional banking sector. And once that crisis boils up and comes to the top, then that is obviously going to send serious shockwaves across US markets and global markets, because it's not only the US regional banks that are in trouble. It's banks like Deutsche Bank, which has more debt than the German government, and Bank Paribas Capital Markets in France, also a huge bank, has also got financial difficulties. And what the banks are trying to do at the moment, they're either trying to fool you or just ride out this particular massive dip in order to get through 2024 and hopefully ride through it and rise up again. It could happen, but it is unlikely because the crisis will deepen. Why will it deepen? Because you've got the Fed, which is going to be cutting interest rates in 2024 in order to save the US regional banks, because as they cut interest rates, the yields on those bonds will drop and the price of those bonds, the value of them, will go up, and that could save the regional banks. However, as the US Federal Reserve cuts interest rates, it's going to provoke inflation to rise further, and as inflation rises further, what you're going to have is a boom bust or a stagflation economy, where you could have rising inflation with no growth. And that throws us back to the 1970s, when that was exactly the scenario back then. There was rising high inflation and no growth, and stock markets then dropped 45%. So we could be looking at a 30 to 40% drop in US stock markets based on the Federal's present policy of cutting interest rates in spite of pretty sticky, quote, inflation in the economies of the West and especially in the US. This is Mayor Valensky with Driving Markets. You can share, subscribe, comment. Catch you later.